Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you are entertained, please like and subscribe. So I just want to talk about your option for options at every price point. And the reason why I've been looking at options, because I do invest a lot in high income ETFs, and the most frequent questions that we get asked are, what about NAV erosion? Do we care about NAV erosion? And do we think that these funds are sustainable? Like, can I put my money in this high income ETF and the fund be around for the next 5 years? So that's what the bulk of what my research has been in for this, and I'm very curious, and I just wanted to share what I've learned so far, and hopefully everybody is entertained and more educated at the end of this. So let's start with, if you have $50 to do covered calls, I would heavily recommend starting with YMAX or YMAG. And the reason for this, and it's not because I feel like these are the best, absolute best high income ETFs. The reason for this is that these are fund of funds, and they're less than $20, and you get about 25 cents per week. And for me, if I had only $50 to invest, seeing that compounding in real time is a very powerful compounding. So being able to see that is really motivational, and hopefully that will help get more money sooner involved in investing. So the pros is that, well, for YMAX and YMAG in particular, their distributions have been about 50%, just so far in this market conditions, the usual. You have a limited loss. And what that means is that if you pay $20 for a share, you will never lose more than that $20. There's no negative. Like, YieldMax can't sue you and get an additional amount of money. Like, that's it. And then you have unlimited upside. That doesn't mean unrestricted, but when the underlying does better and the price, then the price of YMAX and YMAG will go up, and there's no limit to that. So the biggest appeal for high income ETFs, though, is just you don't have to write your own options. You can just pay someone to do it for you, and they have experience, so technically they should do better than you if you haven't learned how to look at charts and the Greeks and just putting your strikes not too far away and not too close. The cons of this is basically the same as buying any ETF, and also relying on your fund manager's judgment, because these are very actively managed. So, if you hang around this community long enough, you'll find people saying like, oh, this was too far out of the money. This is too far in the money. This is too aggressive. It's not aggressive enough. Like, everybody has their own opinion on how the fund managers are doing. And we're all trying to just figure out, like, what they're doing sustainable? And do they know what they're doing? Because just because someone says they know what they're doing doesn't mean they know what they are doing. So we'll continue to keep our eye out and audit and just make sure that it is sustainable and that we can, for the most part, rely on the fund manager's judgment. So, what if you have $3,000 for options? You can do cash secure puts. And what this is, if you have a 25 if you have a stock and it's worth $30, you can select a strike price below $30, so like $25. That means you have collateral of $2,500 if at the end of on the expiration date, the price of the stock is at $25. Now you have to pay $2,500 to own that stock. But because you're taking on the risk of what if the price of the stock goes below $25, what if it's now $10 and you're now forced to pay $20, you collect your premium. So you can use, the Greeks and charts and everything to figure out where you want your strike price. And that is your level of risk that you are comfortable with. And just, it's easier to accept the outcome of a bet if you have control over like the odds of the bet. So if you lose your position though, like the stock was $30, you put it at $20, now it's at $29. Well, sorry, it's $19. So you bought it at $20, okay, well, and it's worth $19, but you still own the stock. And now that you own the stock, you can do the wheel strategy, which is basically just doing covered calls on 100 shares that you own. So, like even if you lose in the long term, you can win. And the cons are like, if the stock goes to $0, then you don't really own anything. And if you're using margin, or like, just be careful, because the entire option value of that strike is held as collateral until the expiration of the call. So if we want to back up a little bit, if you have more than $50, but I wouldn't say less than $3,000, because it depends on the price of the stock that you're doing. But if you have more than $50, you can do put spreads. Oh, that also applies for this $3,000. Like, if you're going to do something like SoFi, which is still $14, you only need $1,400 to do cash secure puts. But you have to be careful with stocks that are, closer to $5 than $50, because there's a reason why they're $5. And so are they good companies that, had a bad streak of luck and are recovering, or are they just bad companies to own? And so, like, cheaper's not better necessarily. So $30 is like a new ETF that just came out territory. And it just gets more expensive as you go. So if you have $50+, you can do put spreads. And the way that these work is, if the stock is at $100, you can sell a put at $80. And then if you choose a spread of $10, you would have bought a puts at $70. So the stock is worth $100, you sell at $80, and then you buy at $70. And that $10 is $1,000 of collateral. And then, but you can go as low as 50 cents per share. So I think about this in like the terms of the entire contract, because it's easier than thinking of it as 50 cents, because it's actually $50. But like, you collect premium just the same. The only difference between only the difference between, like, only the width of your spread is used as collateral, then you have a limited downside, but the con is you have a limited upside as well. And then that's just a feature of how this works. And then you have the ability to do more contracts. One of the cons is if the stock goes down too rapidly and you cannot roll out of your position, like do risk loss mitigation, then you can lose the entire amount of collateral that you put in, and you don't even get shares on the other side. You just, lose $100. And then you get less money per contract unless you use a large enough gap. And I noticed this when I was looking at the SPY. So, like, the SPY is nearly $600 right now. And so I don't want to be putting up $60,000 for my premium, or like for my collateral. But so that's why I did, we'll go over the leaps later. That's why I did a leap. But because I don't have $60,000 right now. But you can choose your strike price, which will be closer to $60,000. And then if you use like a $25 spread, that premium that you collect will be the same as if you just did a cash secure put. And so you can, pay to play with, $2,500 instead of $8,000 that you do with the leaps. So, but the risk of that is that for the leaps, you have two ways of making money. And for doing the put spreads, it's really risky that you could lose, $2,500 and you won't have any stocks at the end of the day. So, like, it's more risky, but it's cheaper. So, let's go on to the next one. But if you have $8,000 or more, you can do the leap strategy, which is you buy a call very far in the future, very deep in the money, and then use that as the collateral for your covered calls. And so your pros is that you have unlimited upside for the call that you bought. Just it depends on how far in the future I guess it depends on how much time you have until that bought call expires and how the market conditions are at the time. So I think one of the bigger differences between me doing a poor man's cover call and YMAX doing the poor man's cover call is that I believe that YMAX only does like a month out, but I am doing like 2 years out because that gives me like so much time, at least a year of using this call, and then a year, not a whole year, but like 6 months to figure out like if the market's doing okay, I might roll it sooner, but if it's not doing okay, that gives me time to let the market recover a little bit and maybe lose less money on it. But yeah, so you can use $8,000 instead of $60,000 to use on the SPY, which you can use less money than $8,000 if you choose a different type of stock that's cheaper. But a lot of people do recommend starting with SPY because it has, less IV and it's the S&P 500, so it's not going away. And there's a lot of volume, there's lots of interest, so very tight call spreads. So like that's why most people recommend the SPY, and that it's like a good starting to learn how to do option. So then you can use the collateral for selling the calls, and so you've used less money, but you can still do the calls that you wanted to do. And then the cons is you have to be very diligent to close your positions because you can't technically be assigned, and you can't, and at least for Robinhood, you can't be short. So you do have to always close your positions and roll them over. And there's a difference between, like, I had to pay $1 to roll it over versus we're getting really close to the price or it's in the money and now I have to roll it over. That's going to be really expensive, and that's when you lose money in options. So you have the risk of the price going down and losing money on the bot call, but if it's like the S&P 500, then if you roll it forward, the chances are the next time you earn money. So in conclusion, which option do I think is the best option? Also, for all of these price points, you could just do high income ETFs. You don't need to manage it. You just get money and it's fine. So in the best case scenario, if everything goes exactly correct, you are amazing at picking your own strikes and you hardly ever lose. I think leaps, specifically leaps that you do with the major indexes, have the potential for the biggest gains. And I mean, you could do leaps on single stocks, but it's very, very risky. And I mean, it's up to your risk tolerance. But yeah, leaps in the best case scenario, because when I was doing my math, trying to figure out like what premium I would need from the SPY in order to beat XDTE, I could probably make the $8,000 I paid to open up like my bot call in a year and a half, which is like when I would want to roll my position anyway. So I just spent a year and a half doing cover calls only to pay myself back. But if the SPY goes up 20% in that time, I actually profited like 40 to 60%. So the bot call acts as like a 2x leverage. So like I can actually get a 60% return, and the cover calls that I did for that amount of time paid for the bot call. So when I go to sell it, whatever I sell it for is profit. So that one's the hardest one to explain how you make your money, but it has the highest principal that you have, like initial starting value besides cash secure puts of it has a very high premium. So in the medium case scenario, I really do think the high income ETFs are the way to go. And that's because you can be in multiples of them, and they do have fund managers, and they do know what they're doing. And so like there's a really big possibility that you could have a series of these options open, the entire market falls flat on its face, and then you lose all of your money, and that's not amazing. But at least if the funds are still alive, and like even if they reverse split, like that $20 you paid is safe and will continue paying you an income because they're making premiums. So it is sustainable. And then in the worst case scenario, I mean, that would also be the high income ETFs, but I do like the spreads, the put spreads, because especially for riskier things like my MSTX that I've been eyeing and really enjoying. So I had to drink something because my throat is scratchy, but yeah, so like MSTX, it's a Bitcoin play. It's on a big bull run right now, so everybody's excited, but we all know that Bitcoin pulls back. It's what it does. It hits the ceiling and it doesn't go through right away, so it shoots right back down. So Bitcoin really could, MicroStrategies really could go down like 50% in a day and we would have no one to blame but ourselves. But if we did the spread and only like 1 to 5% of my portfolio in it, then if I like really lose the bet and I wasn't able to roll it on time or do my risk mitigation or whatever, close the position, like, then at least I only have whatever I opened up the position for, like $100 or $500. Like, instead of risking $10,000, I'm risking $100 at a time, and I put out like 5 contracts. Like, who cares? I mean, me, I will forever be salty about it, but that's what happens when you use leverage products and make bad bets. So I think that in conclusion, if you should be doing a mix of things, maybe, or actually, I have no recommendations whatsoever, because I think there's more than 2 types of people, but there's 2 main types of people. People like me, that I came in from just like a 3-fund portfolio. I've never touched options before. I've always heard how dangerous options are. Always wanted to stay away from it. And then you have people investing in high income ETFs that have already done options to get rich. And their value proposition is like, I've done it. It's stressful. I've lost a lot. I've gained a lot. I know what I'm doing. I can read the intraday trades and I know what they're doing. And I am wanting to be retired, and I just want to pay someone to do this. So I think that if you want to make extra premium, or you think that you can, like, you have a different risk tolerance than whatever funds are offering, then do it yourself. And if you want to hedge against like YMAX, like your high income positions, just, if you do it yourself, then like you're not probably going to go bankrupt. Like, you can do your own, because if you're afraid that like there's not enough popularity. Basically, if you think that the fund is going to go away, if like like maybe in a bear market, like, don't get out of these funds, but like you can play with your own options, and just in case the fund goes under. I don't know. But yeah, I'm still a fan of all of the high income ETFs, but I am starting to experiment more with options and different strategies, just to, actually experience what it's like to do it on my own. And that way I can confirm that actually I really do just want a manager to do this for me. Anyways, what are your favorite option strategies? And if someone only had $50, which fund would you recommend to them? I will talk to you later. Bye.